Imagine you have $10 billion sitting in stocks. You need $100 million to buy a yacht, a private jet, maybe a second mansion in Monaco. A normal person would think, just sell some stock. You have $10 billion, selling $100 million is nothing. But that's not what happens. Instead, the billionaire calls their bank, puts up the stock as collateral, and borrows the $100 million. They get the yacht, they keep the stock, and somehow they pay almost no tax. You're not misunderstanding that. That's exactly what's happening. Here's what most people don't realize about wealth at that level. The moment you sell something, a stock, a piece of land, a business, the government considers that income, and income gets taxed. In the U.S., that can mean anywhere from 20 to 37%, depending on the asset and how long you held it. On a $100 million sale, that's potentially $20 to $30 million handed to the IRS before you've bought a single thing. But borrowing is not income. A loan is not money you earned, it's money you owe, and the IRS does not tax money you owe. So the billionaire borrows against their wealth, spends the loan, and the tax bill, for now, is zero. This is not a loophole in the traditional sense. It's not hidden in fine print somewhere. It's built into the basic structure of how assets and debt work. It's just that at $100 million, the math becomes extraordinary. Now let's talk about what happens to the loan itself. The billionaire owes the bank $100 million plus interest. That sounds like a burden, but think about it from their side. The stocks they used as collateral, the ones they didn't sell, are still growing. If those stocks return 8% a year and the bank is charging them 4% interest on the loan, they're still ahead by 4% on assets worth billions. They used the bank's money to live on while their own money continued compounding. That is not spending wealth. That's using debt as a tool to let wealth grow undisturbed. And here's where it gets stranger. What happens when they eventually die? In the U.S., when assets are passed to heirs, they receive what's called a stepped-up basis. That means the original cost of the stock, the price it was bought at decades ago, is essentially reset to the current market value at the time of death. All those decades of gains, all that appreciation, gone from the tax record, legally, permanently. The heirs inherit billions. They can sell those assets immediately and owe almost nothing in capital gains tax because the basis was just reset. Meanwhile, the loans taken against those assets, the estate pays them off using a fraction of the inherited wealth. The stocks were never sold, the gains were never taxed, the loans funded a lifestyle for decades, and at death, the whole equation resets. This is sometimes called the buy, borrow, die strategy, and it's not a conspiracy theory. It's a documented, legal, widely used approach by the wealthiest families in the world. Now, some people hear this and think, so what? Rich people avoid taxes. That's not new. But the scale of what's happening is worth sitting with for a moment. In 2021, ProPublica obtained IRS data showing that the 25 wealthiest Americans paid a true tax rate, measured against how much their wealth actually grew, of roughly 3.4% on average between 2014 and 2018. Not 37%, not 20%, 3.4%. Warren Buffett, worth roughly $100 billion at the time, paid less in federal taxes as a percentage of his growing wealth than a nurse in Nebraska. This isn't because they cheated. It's because the system, as written, makes this possible. And at that level, every major bank in the world has an entire division designed to help execute exactly this strategy. There's a practical limit to all of this, of course. If markets collapse and the collateral drops in value, the bank can issue a margin call, demanding either more collateral or immediate repayment of the loan. This happened to some ultra-wealthy investors during the 2008 crash and again briefly during COVID.
For most billionaires, a diversified enough portfolio means this risk is manageable. For a few, it has caused genuine crises. But the deeper issue isn't whether the strategy always works perfectly. The deeper issue is structural. When the primary mechanism by which ordinary people build wealth, earning a salary, paying taxes on it, saving what's left, is taxed aggressively at every step, and the mechanism by which extreme wealth compounds is taxed almost not at all, something is happening to the shape of the economy over time. The gap doesn't just persist, it accelerates. Economists have debated for years how to address this. Some argue for taxing unrealized gains, meaning the growth in asset value even before a sale. Others point to reforming the stepped-up basis at death. Others say the interest on loans secured against assets should be treated as income. None of these proposals have passed in any major economy. The lobbying against them has been substantial, and the people most affected by these proposals are precisely the people with the most resources to prevent them from becoming law. Which raises a question worth sitting with. If a system this powerful, this legal, and this lopsided exists and has existed for decades, is it a flaw in the design, or is it working exactly as intended?